Hey traders, Nick Shaheen here looking at Tattooed Chef, TTCF. Popular stock. Let me start by saying I closed my longs because it was a trade, and I think I got long here somewhere. Shared it with the folks in the chat room and the readers. And this, my statement would be, to say it nicely, this is not an entry point. And I'll tell you why in a second. If I'm long for a trade, this would have been my exit. If I got long here, this is my exit number one. Somebody that's buying it here is not, either has a very, very long-term perspective or does not know charts. Either case, if it's a long-term perspective, I get it. So the argument for that is that, hey, over the long term, it's not going to matter. Well, if that's true, why not wait out another tick? It's not going to matter, right? So why not wait out a tick? What you're missing out on? Just a potential $2 drop. If you miss out on a dollar pop, it's not going to matter over the long term. So the argument cuts both ways. I personally am allergic to getting in where the stock has failed before on several occasions. Okay, so let me show you my lines and then we'll go from there. So I'm not a hater. I was long. So in fact, I will buy every dip. At what level depends on the chart. So this was the resistance and an opportunity and delivered quickly. This was the resistance and an opportunity and delivered quickly. But here's the opportunity that was the best one to get, which was buy the dip, because then you're not buying somebody else's profits. Maybe you're getting in too soon, but if you're a long-term perspective, it's not going to matter. It works better this way than that way. That's my personal opinion. Of course, I'm not here to convince anybody otherwise. I'm just telling you what I think of the chart. Right here, if I look left, it had one massive failure in June and a huge problem from February. So that doesn't mean it's going to fail again. It just means that it's not an obvious point of entry. You just came back into a place where the bulls have gotten shellacked twice. That's how they break out. They come back to the place where they failed and they keep trying and they keep trying. But you just had a 50% rally. What's wrong with waiting out another tick or two to see? Ideally, what you want to see is failure, which is okay, but don't lose the progress you made. So you fail somewhere along here, you find footing, you come back, and you address it with better oomph, and then you break out to your next level, rinse and repeat. That would be my perspective. So short term, this is if I'm chasing because I see it moving and I want to get on the train, this is absolutely not the right place to do it. The better place is above. Once they break through at least this one, there's still a lot to deal with, then I would. Otherwise, I would wait for the dip, hopefully a substantial one. I shouldn't say that, hopefully substantial one. I wait, I'll buy the dip, and then try to rally back up. The reason why, especially if I'm using options, when the stock is crashing up like this one, then it is the calls are superheated. So whatever I'm buying in calls, I'm overpaying over normal price action. So you know, I haven't looked. This is my practice platform from E-Trade. I'm not recommending it. It just happens to be the one I've been using. All right, so the implied volatility is 120 something. Let me see. So look at the implied volatility relative to what it normally is. So the stock is extremely heated. So everything I'm, quote, buying, I'm paying up. So here's one thing I should do. If I'm buying a call, I should make it a call spread because then that effect is neutralized. What's the spread? So let's say I'm going out to December and I'm buying a call. Let me show more. Oh, there isn't more. Interesting. So instead of buying this one for $345, I would buy it and sell something above it and collect some money. I can sell whichever one of these. So let's say I sell this one. Now it's $10 wide, right? I'm buying the 25, selling the 35. Buying the 25, this one, selling this one. So this one I'm paying up $350 per contract. Here I'm collecting $175 per contract. I'm spending the difference. So what's the maximum I can make? $10 minus 1.7. So roughly $8 after fees and such if price rallies through both legs. So why would I want to do that? Because I'm buying something at expensive levels. If this implied volatility is too heated, like we just showed from the constellation, then this one is also heated. So I'm buying one, I'm paying up, I'm selling one to somebody who's paying up for me, offsetting the me paying up here. So it's an easier trade. Now the downside of this is my upside is limited. Downside is upside. The downside of the drawdown of this is the upside is limited to $8, but that is more than 4 times my money. How embarrassing is that? Me saying that that's a downside. It's not. The advantage of doing this is it's a slower trade. On bad days, like if the stock drops, the pain is not so much in absolute terms out of pocket. Whereas if I'm long the call, I'll give you an example. Somebody who bought these puts yesterday, guessed wrong because the stock is up 5%, they're down 15% on their money in one day, and that's December. So somebody that did that here is probably down way more, 20%. Somebody that did it this week, down way more. Well, this one is not very liquid. So yeah, I would stick to the monthly ones where there's volume. I wouldn't mess with these weekly ones. So my pick would be December. October the nearest. I wouldn't mess with September either. Then you have to account for earnings and all of that. So anyway, back to the chart. Fundamentals, I have no issues. It's too young. It's growing fast. So I'm not judging it on the fundamentals. The concept is good. It's got good fans on Wall Street. This drop was ridiculous. I wrote it up and I said, it makes for good sense now. And this happened. In fact, here. So this was the trade on 8/13. The trade on the earnings dip, like I said. So price was $17-ish. Now it's 23-ish, 23 and a half. So I shared it in 4 different ways, actually only 3 in this case. Buying a naked call out to next year, January. The call price was $2.70. Now it's $7. So 150%-ish. If somebody did the call spread, they paid $2.10. Now it's $4.50. So a double, more than a double of their money. If somebody sold a put, that's also bullish. When I sell a put, they collected $1.45 and now it's only worth $1.10. So they can buy it back and they would have made 35 cents out of thin air. No money left their account. When they sell a put, money comes in. So in the video, I probably noted that if I wanted to be really long TTCF, I would sell the put, collect this money, and then with that money, buy the calls. So if somebody did that, then they're really profitable. But that's the point, is I don't chase. I pick my entry points based on the chart, and when people freak out, that's the opportunity. When people freak out, I jump in and see if it's worthy of a trade, if there's an opportunity. For example, Chewy today, falling on the most ridiculous headline I've seen. They missed on sales. No, they didn't. They missed on expectations of sales. They grew sales 26, 27%. They increased margins. They made their loss, the operating loss, smaller. So all around progress. What was wrong was the expectation levels. So they're dropping at 9%. Guess what I'm doing today? So that's the kind of stuff that makes sense. Instead of chasing TTCF, a stock I liked down here, stock I don't like to start up here from a trading perspective. All right, that's it. Signing out. Oh, if you're not a member of this channel, subscribe. It's free so far. Also put the little bell to let you know that I'm posting some videos. And I will put, never mind. I'm still not taking on new signups. Okay, never mind.